Income policy riders. A rider is an attachment to an insurance policy that changes its coverage by limiting or expanding it. The applicant may request a rider to enhance benefits. The insurer may impose a rider to limit coverage. If the applicant requests a rider, the insurer may increase the premium depending on the type of benefit the rider provides. A variety of riders are available for disability income policies, including waiver of premium rider, cost of living adjustment rider, social insurance supplement rider, future increase option, also called guaranteed insurability rider, return of premium rider, annually renewable term life rider, waiver of premium rider. A waiver of premium rider lets the insured skip premium payments during periods of total disability. Typically, the insured must first pay the premium during the elimination period or for some period, such as 6 months during disability, before premiums are waived. If the insured remains disabled after that period, the waiver takes effect back to the first day of disability. Any premiums paid during the elimination period are then refunded to the owner. Future premiums are waived while the disability continues. Most policies now include a waiver of premium provision as a standard clause, not as a rider. No additional premium is charged. Cost of living adjustment, COLA, rider. Disabled insureds may need to live off their disability income benefits for many years. For this reason, some may want these benefits to keep pace with inflation. A cost of living adjustment, COLA, rider does this. The COLA rider adjusts the benefit payments according to changes in the Consumer Price Index, CPI. During times of inflation, the adjustment increases the payments. During times of deflation, payments are reduced. However, the monthly income from total disability benefits will never be lower than the initial disability benefit amount stated in the policy. When the disability ends, the insured may set the policy's benefit at the adjusted amount being paid at that time. The insurer will adjust the premium accordingly. Social Insurance Supplement Rider. A Social Insurance Supplement, SIS, rider, also known as a Social Security rider, pays an additional monthly benefit before Social Insurance Program benefits begin. Social insurance programs include Social Security and workers' compensation. It is not easy to qualify for Social Security disability benefits. They do not begin until the person has been disabled for at least 5 months. The SIS rider pays benefits during this qualification and waiting period. Disability income benefits paid under the SIS rider are either reduced or ended when Social Insurance Program benefits begin. This reduction or elimination of benefits under the SIS rider helps insurers avoid overinsurance. Future Increase Option Rider. A future increase option rider lets the insured periodically buy more coverage under the policy without providing evidence of insurability. Also called a guaranteed insurability rider, it appeals to those who expect their earnings will increase. Usually an insured must exercise this option to buy more insurance before reaching a specified age, such as 45 or 55. The insured has a narrow period, typically 30 days or less, within which to exercise the option to increase coverage. When this period ends, the option is suspended until the next period. If the insured increases coverage, the insured pays an additional premium, usually based on the current attained age, for the additional coverage. As long as the policy remains in effect, an insured who is disabled and collecting benefits at the time of an increase option date can increase coverage by exercising this option. Return of premium, refund, rider. A return of premium rider lets the insured get back some of the premium paid if he or she has made no claims against the policy. Likewise, if the insured's claims are below a certain level, he or she can also get back part of the premium. Example: Suzanne's DI policy has a return of premium rider which states that after 10 years, 80% of the premiums she paid during that time will be returned to her, less the amount of any benefits paid. If at the end of the decade she has paid $5,000 in premiums and claimed no benefits, she can receive a refund of $4,000. With a typical return of premium rider, the insured pays a premium in addition to that required for the disability policy. That additional premium plus the interest the insurer pays and credits to the additional premium creates a cash value. This cash value is payable to the insured on dates specified in the policy. The amount of any claims previously paid are deducted from the cash value. Riders that allow for the insured to get a return of premium by minimizing claims are sometimes criticized for discouraging legitimate claims. As a result, they are not available in all states. Annually renewable term life rider. Many insurance companies permit DI applicants to add a life insurance rider to the policy. This rider provides a death benefit if the insured dies. It is not necessary for the insured to have also been disabled at the time of death for the death benefit to be paid. This rider usually provides annually renewable term life insurance. For your review, a waiver of premium rider excuses the insured from paying the policy's premium during periods of total disability. The COLA rider adjusts the benefit payments according to changes in the Consumer Price Index, CPI. A future increase option, or guaranteed insurability, rider allows the insured to buy more coverage at certain times without having to prove insurability. The insured must usually buy the additional coverage within a brief period and before reaching a certain age. A return of premium rider will refund some of the premiums paid for the policy if the insured made no claims during a certain period, or if the claims were for less than a certain amount.
Okay, everybody, this is a short and sweet video. Here is our 4 questions. I don't know these answers I don't have these answers in advance. I'm taking them as I'm filming this. Most of the time I get them wrong. So if you would like to help me out with doing these questions, please comment below and let me know. Otherwise, I'll just keep recording them. Okay, when Social Security disability benefits begin, the disability benefits from the Social Insurance Supplement rider will, let's see, when Social Security benefits begin, they probably diminish or end. Who was paying attention? Not me. All right, when does a waiver of premium rider excuse the insured from paying policy premium? And if you need help in this area, you be sure and watch this video over and over. You write down the questions, you take a picture of the questions, whatever helps you study. All right, when does a premium rider excuse the insured from paying the policy premium? When the insured is totally disabled, I would think. All right, which rider is not commonly found in disability income policy? Oh boy, which rider is not commonly found? I would say long-term care. The future increase option rider is also known as the it's an option, maybe COLA? I don't know. All right, let's see what's right. I got one wrong. I bet it was that last one. Yeah. So the future increase option rider is known as a guaranteed insurability rider. While the COLA rider adjusts the benefit payments according to changes in the CPI, this does not increase the policy coverage, which the future increase option rider does. So these are some questions you may have on the test. I have not taken the test yet, so I have no idea. But this is what I'm told. All right, when Social Security benefits begin, the disability benefits diminish or end. When does a waiver or premium rider excuse? When the insured is totally disabled. All right, which is not commonly found in a disability income policy is a long-term care rider. That's because they're going to need assistance and forever, so that would make sense. Okay, that's the end of this lesson, and I shall see you all on the next video. Please subscribe, come back and visit. Thanks, everybody.